Okay, good evening, everybody. You're welcome to our case study class. I hope you had a great day. We're going to start right away so that we can manage our time this evening. Please, if you can hear me, kindly confirm by giving some thumbs up. Okay. All right. Thank you for the confirmation. I hope you can hear me loud and clear wherever you are. So we're going to continue with our discussion on ICAN corporate reporting. And this evening, we want to look at two aspects of the syllabus. One of them is IFRS 2, share-based payment. We're going to start with that. And we are also going to check performance measurements around, we'll be focusing majorly on ratio analysis. So let's see how far we can do that this evening. So once more, you are welcome. So we will start with IFRS 2, share-based payment. Obviously, it's a very important standard in your syllabus. So if it's going to prop up in this next exam, how do we tackle questions around IFRS 2 share-based payment? So I need you to listen to me. I'll give you some information. I'll try to explain what share-based payment is all about. Then I'll go to my marker board and try to summarize the entire information around IFRS 2 share-based payment. So let me start by laying some foundation, and I'm going to say this. When a company incurs liability, okay, and it settles that liability in cash, that is cash-based payments. Does that make sense, right? So when a company buys goods or services, or it tries to reward its employee, probably for working for a longer period of time, right? And it decides to reward them in cash, okay? So that is cash-based payment, and that is not IFRS 2. So you need to understand that. The moment a company have to settle its payments by issuing its own shares, be with me. So a company buys goods or services, or he wanted to reward some of his employees for probably working for a period of time. Instead of him paying cash, he decided to issue its own shares. That is share-based payment. Does that make sense to you? All right. So you need to understand that clearly. Then from there, we are able to start solving questions in that regard. So let me take that again. If a company incurs liability or has to settle its payments, but everything is done in cash, what we've been doing before now, probably credit transaction or cash transaction. But the moment a company buys goods or services and is going to settle that payment by issuing its own shares, that is IFRS 2, or the liability incurred that is going to pay is going to depend on its share price. Does that make sense to you? So the liability payable, I will have to rely or I'll base it on my company's share price. That is IFRS 2, share-based payment transaction. So that's what you can see on your screen. I hope you can see my screen from wherever you are. Share-based payment will occur when a company buys goods or services from other parties and settles that amount payable by issuing its own share, right? Or It incurs liability for cash payment based on its share price. So that's technically the two types of share-based payment transaction that we have. So I need you to, you know, understand that so that it makes life much easier. So let me pause a bit so that you can probably assimilate that before I continue. So the aspect of share-based payment will be focusing on service condition and of course performance conditions. Okay, so I'm going to explain all of that when we get there. All right. So let me recap for the last time. So the issue is if all liability that is incurred by a company or all payments done by a company to settle its liability are all cash, obviously IFRS 2 will not apply. But the moment a company buys goods or services or decides to reward some of its employees or directors for working with the company for a longer period of time and decide to settle the amount payable by issuing its own shares or share option, then that is what we call equity settled share-based payment. The other scenario is incurs liability for cash payment based on its share price. So don't get it twisted. If I go to Computer Village and I said I wanted to buy laptops, for example, so normally the guy is going to issue an invoice, let's say 10 laptops or 100 laptops, and the cost is 5 million naira. So if I pay cash for those laptops, that is not IFRS 2. But the moment I have to issue my own shares, that means I have to settle that amount payable by issuing my own shares. That is IFRS 2. Or the cash I'm going to pay, I will have to base it on my share price. That is IFRS 2. You know, the initial, I know I've given you three scenarios now. So the first scenario is I wanted to buy a laptop and I tell the supplier, give me an invoice. They gave me an invoice of 5 million. Then I gave out 5 million. That is not IFRS 2. But if the cash I'm going to pay is based on my company's share price, that is IFRS 2, and that is what is called cash settled share-based payment. Or I have to settle the amount payable by issuing my own shares. Okay, so that is equity settled share-based payment. So technically, we have two types of share-based payment transaction. One is equity settled share-based payment. That amount payable, I have to settle it by issuing my own shares, or cash settled share-based payment. What that means is the liability for cash payment has to be based on my own company's share price. All right. I read that disclaimer, right? Okay. So how do we account for this? So there's a formula you're going to use. And so I'll have to go to my board so that I can demonstrate that. Then we'll look at a couple of questions. We are going to start from simple question, then we graduate to some complex questions. Then we check performance conditions. Then it should be good on IFRS 2, share-based payment. So for me, if you ask me whether it's going to be tested in this exam, I'll rate it 50-50, but I see the examiner testing IS24, probably IS19, but either of IS19 or IFRS 2, obviously, is going to pop up in the exam, right? Because both of them are really talking about, remember, IS19 talks about employee benefit. So here is also part of employee benefit, especially to the directors, so that they wait or the work, or it's kind of incentive, so that directors can take decision in the interest of the shareholders. So that's why share-based payments have to pop up to reduce agency problem and IFRS 2 is dealing with that. Okay, so it's 50-50 actually, so it can prop up in exams. So if it props up, you're going to use this formula. So permits me to go to my board marker so I can demonstrate that. Then we can look at some couple of questions. Okay, so let me share my screen, or my board rather. Okay, so if you can see the whiteboard marker, please signify so that I can go there and write. Okay. Okay, thank you. Thank you for always responding. That is encouraging. Thank you. All right. So I just want, I don't want to be saying everything. I wanted to demonstrate it so that you can relate with it. But again, I have to pick up my phone so I can be checking the WhatsApp in case you can no longer see my screen. I can pause a bit and I'll probably come back to reshare my screen. Okay. So let me just open the group, my phone. Okay. All right, so I'll be checking that. So let me go to the board marker and then try to demonstrate share-based payment. Okay, I hope you got my introduction. Okay, so we said we have two types of share-based payment transaction. So we are dealing with IFRS 2. Okay, so we have IFRS 2. All right. Okay. Okay. So we have IFRS 2. So anytime you have a question on IFRS 2, how will you know? First case scenario, the amount payable, the company has to settle it by issuing its own shares or option, or the liability incurred for cash payment be based on the company share price. All right. So obviously there is a liability. Does that make sense to you? So there's a liability already. So what IFRS 2 says is at the end of each reporting period, that liability must be remeasured. So we have a liability, right? Liability. Please don't mind my handwriting. Sometimes this thing works well, sometimes. Okay. So the liability, the formula for you to remeasure, to measure a liability at the end of each year is going to be number of shares, number of shares expected to vest, expected to vest. So if this is your first time of learning IFRS 2, start calling this formula. So start learning it. Number of shares expected to vest. What does that mean? You are coming there. Multiply by fair value. Multiply by fair value. Then multiply by timing ratio. Okay, multiply by timing ratio. So so be with me. So we number of shares expected to vest. I'm coming there, I'll explain. Then but I'm going to start with the timing ratio. But there is something we need to quickly learn. The fair value we are going to use is this really matters. So this is what I'm going to do. I told you I wanted to use this one straight explanation, to demonstrate the whole of IFRS 2. So for my fair value, I will say, so let me see, I can do something like this. What is the contract? Okay, what is the contract? So the contract the company is giving its employee or its directors will be dependent on how it will be settled. So I have settlement, and of course, so when I have the contract, how will it be settled? You know, we said we have two types of share-based payment: equity settled share-based payment and cash settled share-based payment. So that's settlement you are seeing there. And of course, which fair value will I use? Okay. So what fair value will I use? So let's see this. Okay. All right. So the question now is, these contracts, are you option? So this is shares. All right. So if it is option, it will be settled in equity, right? And in that case, I will use grant date fair value, right? So this is the principle. Once you know the principle, you can solve any question. Does that make sense, right? So what is my contract? So this is where I'm going to start from. If the contract is an option, it will be settled in equity. And of course, I will use the grant date fair value. So this is important, okay? Or this my contract, I use SaaS. Okay, I use SaaS. What is SaaS? SaaS will be settled in cash, okay? So when the liability incurring for cash payments will be based on share price. Understand that, okay? For me to determine the amount of cash I'm going to pay, I will base it on the company's share price. So that is what we call SaaS, okay? And in that case, the fair value is going to be current date fair value. Current date fair value. So please take note of that. So if it is SaaS, what is SaaS? SaaS is Special Anti-Robbery Squad. Oh, sorry, it's not Special Anti-Robbery Squad. So SaaS is Share Appreciation Rights. Okay, Share Appreciation Rights. So that is SaaS. Okay, Share Appreciation Rights. So this is the way I can help you to demonstrate the entirety of IFRS 2. So let me take that again. When you see a question, okay, when you see a question, what comes to your mind? You're going to ask the question, what type of contract are you? Are you an option? How will I know? The examiner will always mention it. They can say on 1st January 2021, an entity granted an option scheme to 10 of its employees or 10 of its directors. So obviously it's an option. And once it's an option, I'm going to settle it in equity. That is equity settled share-based payment. What does that mean? That means the entity will use its own shares to settle that liability, okay, or to settle the amount payable. And when you are slotting the fair value in your formula, I'm going to use the grant date fair value. So take note of that. I will use the grant date fair value. What is the grant date fair value? Grant date fair value is usually the date the shares were granted, okay, or the entity promised its employee or its directors that is going to give them shares if they work for him for the next 5 years. Usually the beginning of the contract, and it's usually the beginning of the accounting period. So that's meaning of grant date fair value. So if the examiner has given you 5-year contract, okay, and you're going to calculate your liability for all the 5 years, then you will use grant date fair value across the 5 years. So that means when I'm computing equity settled share-based payments, my fair value will be constant, okay? My fair value will be constant. Please understand the principle. That's why I normally spend time explaining the principle. Once you understand the principle, we get to a question, no matter how big it is, in 2-3 minutes, we are done. We'll solve the question. So understand it. If you don't understand it now, you see that you keep asking me a lot of questions when we start solving IFRS 2 questions. So that's why I said, if this is your first time of learning IFRS 2, so please pay attention. And if you have a fair idea, obviously it will just be a kind of revision for you. So let me take that again. Let me take that again. So if I have an option, that means it will be settled in equity. How will I know in a question? The examiner will tell you on 1st January 20X1, an entity granted an option scheme. Did you see that? Option scheme. You always mention it. So that means it will be settled in equity. All right. What's the meaning of that? That means the company has to issue its own shares, to settle the amount payable. And of course, the fair value that will be used is the grant date fair value. That's the date the entity promised its employee or its directors, or the date it granted them his own share. Okay. But because he said there's a condition to it, which is a service condition. Work for me for 5 years. Okay. Work for me for 5 years. Then I'll give you, let's say, 1,000 unit of shares. That's why you have in that formula number of shares expected to vest. Because if you did not work up to that 5 years, it will not vest. That means it will not mature. Okay, you'll be entitled to it. That's the meaning. That's the meaning of number of shares expected to vest. Okay, but at the end of each reporting period, we have to measure the liability. Do you know why? Because the condition is the service condition. So IFRS 2 is saying because we have provided that service, let's say in year 1, so the expense, the expense must be recognized in the income statement, even though it doesn't involve movement of cash. Okay, so that's what IFRS 2 is saying. It doesn't involve movement of cash, but you must recognize it in the income statement because the service has been provided. And if it is SaaS, what is SaaS? Share appreciation right. That means the liability incurred or the cash payable will be based on the company's share price. So in that case, it will be settled in cash. And the fair value I'm going to use is the current date fair value. Okay, I will use the current date fair value. What does that mean? I will simply use the fair value at the end of the year. Remember, this liability will be remeasured at the end of each year. Can you see that? So that liability will be measured at the end of each year. So what is the current, what is the fair value as at 31st December year 1, 31st December year 2, year 3, year 4, and the likes like that. So if the examiner gives you 5-year contract, obviously your fair value, if it is SaaS, will not be constant. You'll be using the current date fair value. But for option, your grant date fair value is what you're going to use. That means your fair value will be constant throughout the 5-year period. So please take note of that. If you can understand that, then we are moving on. Now, so I have explained fair value. So let me now come to timing ratio. So please be with me here. How do you do your timing ratio? So let's say the contract is for 5 years, okay? The contract is for 5 years. Whether option or SaaS, it is 5 years, okay? So the contract is for 5 years. Now, be with me. 2 things. The examiner can say you should compute the whole of 5 years, although I've not seen any ICAN exam like that, maybe 2 years or 3 years. That's what we normally test. All right. But let me just use 5 years for the purpose of this class. So the 2 things that could be 5-year contracts. Please be with me here. That could be 5-year contracts. So when you check the requirement, the examiner can say just do up to 3 years. That's the first option. Okay. And he can say do the whole 5 years. So be with me. Be with me here. So if they ask me to do whether 3 years or 5 years, so what this means is this. If they ask me to do for 3 years, that means I will stop at year 3. Okay. Obviously, there won't be information for year 4 or year 5. Even if there is information for year 4 and year 5, if you do it, you're just wasting time. So the requirement will tell you how many years you're supposed to do. So now in year 1, when I'm doing my timing ratio, remember I'm explaining that formula. Liability equals number of shares expected to vest multiplied by fair value multiplied by timing ratio. Okay. So if I'm doing year 1, okay, so you agree with me that year 1 will be 1/3. Okay, 1/5 because it's for 5 years. Okay, it will be 1/5. So if I'm doing year 2, okay, my timing ratio will be 2/5. Does that make sense to you? If I'm doing year 3, my timing ratio will be 3/5. Okay, so if you want me to stop at year 3, I will stop like that. So that is my that is what he wanted me to compute. But if you want me to do the entire 5 years, what happens? You want me to do the entire 5 years. So that means I'll still say year 4. I'll say year 4. It will be 4/5. And of course, year 5, it will be 5/5. So that's the meaning of timing ratio. So the moment you see a question and it is IFRS 2, the first task is this. Is it an option or SaaS? Okay. Once you determine that, the next task is this. What is the life of the contract? Is it 2 years? Is it 3 years? Is this 4 years? Because it will impact on your timing ratio, especially what you are using at the denominator. Okay, it will impact your timing ratio. So you need to ask. And the third one is, how many years did the examiner want me to do? Okay, because if you don't understand that, by the time, for example, if he gives you 5-year contract and he wanted you to do just 3 years, by the time if you don't pay attention to that and you want to do year 4, the question may not provide you information about year 4. And the next thing is, this question is not correct. What's doing ICAN? Well, obviously, the question is correct. It's you that didn't know that you're supposed to stop at year 2 or year 3, as the case may be. And if you want it to do for the entire life of the contract or the option scheme or SaaS, okay, it will provide information in that regard. So that's why you need to know the principle. Once you know the principle, it's easier for you to navigate when you see IFRS 2 question. I think it tested it maybe 3 or 4 days ago. That was last time we tested IFRS 2, and that was a popular question there, Kutu PLC. Everybody saw that question in class, and it was so very simple, very straightforward. Okay, so that is how to calculate your timing ratio. Okay, so I have explained fair value and I've explained timing ratio. So let me come to number of shares expected to vest. I hope you can see my screen. Sorry. Okay. Okay. I didn't have any complaint about the screen, so that means you can see. So number of shares expected to vest. So let me give an example. So let's say in the question, the examiner says is awarding, or the company is giving out 100 shares. Look at this, 100 shares. Okay, 100 shares to, let's say, 5 employees or directors. Okay, 100 shares to 5 employees or directors. What does that mean? The number of shares, sorry, 100 shares to each. Let me say that, to each of the 5 employees, each. Okay, so the moment it is each, that means each of them will receive 100 shares. That's the meaning. So 100 shares to each of the 5 employees. So that means I will simply say 100 shares multiplied by 5 directors. So to give me the number of shares expected to vest. But if it says 100 shares to all the 5 employees, it did not say each. That means the 5 of them will share the 100 shares. That means my number of shares expected to vest will be 100. Can I take that again? Please pay attention. There is more to this, okay? But I will not explain that now. When I'm solving question, that's when I will explain it, right? That's why you'll be seeing 5 employees left in year 1, 10 employees will leave in year 2. How does that impact number of shares expected to vest? I'll do that when I get into a question. But understand this basic information first. If 100 shares are granted to each of the 5 directors, that means you will multiply, okay? Because it is each of them. You say 100 multiplied by 5 directors, or 1,000 shares multiplied by 20 directors. But the moment it says 100 shares to all the 5 employees, or the 5 directors, or you may not even mention their number, automatically you don't multiply with anything. That means all of them will share the 100 shares. So that's the meaning of number of shares expected to vest. Okay, please take note of that. But remember, I told you I'll still come back when I see a question to start looking at whatever, be measuring the liability at the end of each year. So what happens if certain people or number of people had left the company? How does that impact on the number of shares expected to vest? So when I get there, I will explain that. Thank you for listening. Any question for me? Any question for me? I hope you are getting the gist. I hope you are getting the gist. If you are dozing, please wake up. I'm just seeing your question. Please explain grant date again. I think I've explained over and over. So have you understood that? Or do I still need to re-explain? Grant date is usually the beginning of the accounting period. So don't worry, when we see questions, you will understand better. Okay. I'm just trying to demonstrate that so you can screenshot that so that it's easier for you to revise IFRS 2. Okay. All right. I hope you are getting the gist. So let me go back to my material so we can solve the very first question. Okay, so let me see. I can share the screen again. IFRS 2 share-based payments. Okay, please confirm you can see my slide. Oh, great. Thank you. All right, so let's go to, so I've explained this. Okay, can you see? So these are the two types of share-based payment: equity settled and cash settled share-based payment. Okay, so for the accounting treatment, don't worry when I say a question out. So I mentioned that we will recognize that in expense, right? Okay, because the argument is the service has been rendered and it was accounted for in that accounting period. So that's why it has to be recognized. So we have question 1. So let's take a look. Benny offered directors an option scheme based on a 3-year period of service. The number of rights taken by the directors at the inception of the scheme was 100 million. The option was exercisable shortly after the end of the 3rd year. The fair value of the option and the number of rights expected to vest were at each relevant point. So we have year 0, year 1 to 3, rights expected to vest, fair value of the option, then required, what is the financial statement effect? Okay, so, I told you I'll start from a simple question so that you can understand how it works before we go to more complex questions. So how do I know that this is IFRS 2 question? How will I know? It says Benny offered directors. So here, he offered directors. So look at this. So that's how to analyze question. An option scheme. You don't need a soothsayer to tell you that this is IFRS 2. The examiner is not under obligation to tell me the requirement. So the moment I see a company offering its directors, its suppliers, its employee an option scheme. So what that means is this: instead of him paying cash, he decides to issue its own share. But he will always call it option because they are not under obligation to accept. When you say something optional, so they can either accept or reject, or they can walk away. Okay. And so since I already know that this is option scheme, then I recall my principle. The moment it's an option scheme, it means it will be settled in equity. And the fair value I use in my formula is the grant date fair value. Does that make sense to you? All right. So once I determine that, the next question I will ask is this: what is the life of this option? The question we always tell you, it says 3-year period. Can you see? 3-year period of service. So this is service condition. So it's a condition. So they call it service condition. After this now, after I teach you the complexity around number of shares expected, the next thing you need to learn is the performance condition. Then that will be all for IFRS 2. There are some other complications, but the examiner won't bother you about that. Okay. Now, so we have 3-year option. So that's the three. So it's 3 year. But when you look at the final, the requirement, it says what's the financial statement effect. So obviously, we wanted us to do for the 3 years. So it has given us the position in year 0, year 1, year 2, year 3. Right expected to vest. It has given us in each of those years, and it even gave us the fair value of the option in each of those years. But remember, the fair value I'm going to use here is the grant date fair value. So obviously, at the beginning of year 1, which is year 0, the beginning of year 1 is year 0. The day you were born, that's when you become 1 year. You are going to spend another 12 months before you become 1 year. Okay, so that means the beginning of year 1 is year 0. So you should have learned that in your SFM as well. You are writing SFM actually. Okay, when you are doing investment appraisals. Okay. All right. So that means I will use 40 cover throughout. Okay. So I would like to solve this question so that you can see the flow. All right. So it will be easier for me to explain other question. If you don't mind, can I go ahead? Let me solve it on the board marker. It's a very simple question. As I mentioned, let me start from simple to complex. So I've already analyzed the question. So I think I will need to get the question physically here so that I can be checking. Okay. Okay. So yeah, I have the bigger material here that contains all the accounting standards. Okay. All right, Benny. All right. So I think I have it. All right. So let me go back to my board. Okay. Yeah. So if you can see my screen, please. Okay, thank you for the confirmation. All right, so so please, if you can't see my screen, just go to the WhatsApp platform. I'll come back here. So I have to go to the board now. So let me get a new whiteboard marker. Okay. All right. So I hope you can still see my screen. Please just pay attention, right, as I solve this question. So the name of this company is it Benny? Yeah. Okay. So the solution is in your pack actually. Well, let me solve it so that you can understand. Okay. So we have Berlin. Oh, can you imagine? This thing is working better. Okay. All right. So this is an option. Don't forget. So it's an option scheme, right? So it's an option scheme, right? So what that means is the instrument will be measured using the fair value at the grant date. So I will write those narrations in the pack. So don't let me waste time on that. So I will now tell the examiner that my formula is liability equals to number of shares expected to vest multiplied by fair value, right? Multiplied by timing ratio, right? Okay. All right. So now, because I'm teaching, so let me break it down. I'll say, let me say start. It's because I'm teaching. So once you understand it, you will not do all of this again. I have increase. I have closing year 1. All right. I have increase. I have closing year 2. You know, you wanted us to do your 3 years, right? So I have increase, then I have closing year 3. Okay. So it's because I'm teaching. So if you after you've understood it, so you can just do closing year 1, year 2, year 3. So the difference between year 1 and year 2 will give you the increase, right? I will go to the expense. So it's as simple as that. So let's now go to the question. So that start is year 0. Now be with me here. Not all the time the examiner will give you information about year 0. So it's usually at the end of the year, because this liability is being measured at the end of the year, right? It's being remeasured at the end of the year. And again, don't also expect the examiner to arrange the question like this for you. It's always a narrative, okay? But because I'm teaching and because of the peculiarity of the standard, so that's why I'm trying to break it down. We always give you those information in narrative, and if you are lucky, it gives you in a table like this. It had made life easier for you. All right. So here it said in year 0, right expected to invest is 97. So I'll say he has already done that, so I don't need to multiply. Right. So I'll say 97 million multiplied by fair value, that is 0.4. That's 40 cover, right? So that's 0.4. Then multiply by timing ratio. So this year 0, so it will be 0/3. Does that make sense? Okay. So obviously, whatever you have done here, you will get 0. Okay. Right. So I come to closing year 1. It says 90 million, right? Multiply 0.4. So why am I using 0.4 again? But when you see the question in the fair value of the option in year 1 was 45 kobo. The reason is this, because I'm dealing with an option. So the fair value I'll use is the grant date fair value. Does that make sense? Grant date fair value. So please understand that grant date fair value. So that means my fair value will be constant throughout. If it is SARS, it will not be constant. That means if it is SARS, I would have used 0.45. Does that make sense? So please take note of that. Then closing year 1, I will now say 1/3. Okay, I'll press my calculator. I'm coming back. So in year 2, it says 93 million, multiply 0.4, multiply, because I'm in year 2, 2/3, right? And the last year, year 3, so to be 94 million, multiply 0.4, multiply 3/3, okay? So that is what we are doing then. Okay, so I'll pick up my calculator. I will now say 90 times 0.4 times 1 divided 3. So this gives me 12, right? So this will give me 12. Then 93 times 0.4 times 2 divided 3. So this is giving me 24.8. Then 94 times 0.4 times, oh, that should be 1, right? Okay. So this is giving me 37.6. Okay. So be with me here, please. Be with me. So I'll now check what's the increase. So this 0 and 12, it has increased by 12, right? So this is 12 and 24.8. So that should have been 12.8, right? So it has increased by, between year 1 and year 2, has increased by 12.8, right? Then 37.6 minus 24.8. So this also increased by 12.8. Okay. So this was the position. So how do we post this? So we will now say, now please be with me. You're almost there. So I will say expense, right? And because I'm dealing with option, I will say it will be settled in equity. Does that make sense? So if it was cash-based payment, we are dealing with SaaS, it will be settled in cash. So instead of equity, you will say liability. So please take note. You will say liability. So take note, please. Okay. But because this is SaaS, it's settled in equity. So all you need to do now is in closing year one, right? So there's an expense of 12. Okay. Sorry. So there's an expense of 12. I would have posted 12 here. So that means I will debit expenses and credit my equity. Okay. In closing year two, all right, that 12 has risen to 12.8. By how much? It has risen to, I will post 12.8 as an expense. Does that make sense to you? So I post 12.8. And the other entry, if I post 12.8, all right, I debit expense by 12.8 and I credit equity by 12.8. Remember in my equity, there was 12 there before because it's for 3 years. So I'll be accumulating it in my equity. So if I post that 12.8 to the 12 that was already in my equity, it will give me 24.8. Okay. In the closing year one, year three, that liability or obligation has also increased from 24.8 to 37.6. Okay, so it has increased by 12.8. So I'll recognize expense of 12.8. So if I post this 12.8 to my equity side, I have 24.8 there. So by the time I credit it, it will rise to 37.6. Okay, so this is your expense. Okay, it goes straight to your income statement. And this is what is called share-based payment reserve. Share-based payment. Okay, reserve. So you'll be accumulating the reserve, the equity in that. Any question for me on this? Any question for me? So you have the solution. I just wanted to demonstrate that. Okay. So if you have known this, you don't need to do start increase. Just go to closing year one, closing year two, closing year three. So the difference between year one and year two, that will give you the increase. So you debit your expenses and credit your equity. So you'll be debiting your expenses without increase and be crediting your equity without increase. So obviously, you'll be accumulating it in your equity. So it will be increasing year on year. Okay, so any question from you? Any question? So this is clear, right? Okay, I guess. I hope it's clear. Any question? Okay, no question. All right. So let me go back to the material, and I think I have an example of SaaS. Let me check so that you can see how that works as well. This, if you can see my screen, kindly signify. Okay, great. All right, so this is the solution. This is what I've just done. Can you see that? Okay. I think the way I even did it over there was even quite interesting. Okay. So this is what I've done. So let me, oh, okay. I didn't solve this question. Oh, it's a classwork. Oh, I see. So you can actually solve this. So let me explain. So when you are solving this, so here, the examiner is saying, calculate your liability is an option, and if it is share appreciation right. Okay. So you calculate your, what's it called? Your liability. So when I'm doing option, I just did option for you. So obviously you use 20 cover throughout. Okay, you use 20 cover throughout the 3-year period is an option. Then if it's share appreciation right, that means in year zero, you use 20 cover year one, you will use 27. Sorry, the UPS is making noise. Sorry about that. This is single off. Year three, you will use the three cover if you are dealing with SaaS, right? And that's why in year two, the three cover, then in year three, 29 cover. Okay, so that means it will not be constant. So please practice that at your leisure. So let's now go to the narratives. You know, I told you, don't expect the examiner to arrange them for you the way he has done in that way. So you may want to expect him to give you in a narrative form, just like you have seen here. All right, so let's go through this. Bet granted 200. Let me just wait for this to go off, to soon go off. I hope you can hear me properly. Sorry about that. Bet granted 200 share options to each of its 10,000 employees on December 1, 2006. The shares vest if the employees work for the group for the next 2 years. On December 1st, 2006, Bet estimated that there would be 1,000 eligible employees living in each of the vesting dates. At 30th November 2007, 600 eligible employees had left the company. The estimate of the number of employees living in the year to 30th November 2008 was 500 at November 30, 2007. The fair value of each share option at the grant date, December 1, 2006, was 10. Sorry. The share option have not been accounted for in the financial statement required. What is the financial statement effect for the year ended 30th November 2007? Okay, so we have seen the complexity here. So they are saying some people left, some people did not leave, and all of that. So let's analyze this. So when you look at the requirement, you wanted us to do up to November 30th, 2007. And from the question, the accounting period began December 1, 2006. So obviously, he wanted us to do just 1 year. So December 2006 to November 30th, 2007 is just 1 year. But how will I know that this is IFRS 2 question? It says, bet granted share option, can you see, to each of its 10,000 employees. So this makes the question IFRS 2. So please take note of that, okay? Granted 200 share option, can you see that? Now, to each of its 10,000 employees. So that means if I'm calculating my number of shares expected to vest, I will multiply 200 share times 10,000. That's the mean, okay? Aside the complication anyway. Now, they now said the share vest if the employee work for the group for the next 2 years. So this is the life of the contract. So that means when I'm doing my timing ratio, I will use over 2. Does that make sense? The denominator. So it will be 2 because it's 2 years, right? So, but he wanted me to do just for 1 year. So that means I'll just do maybe 0/2 and 1/2. That's all. Okay. Now, on 1st December, it now said Bet estimated that there will be 1,000 eligible employees living in each. That means from year one, the beginning of year one, is saying they're estimating that 1,000 eligible employees will live in each year up to the vesting date. And remember, vesting date is that will be November 2008. Okay, that means 1,000 will live in year one, 1,000 will leave in year 2. That's total of 2,000. So how does that impact what we want to do? I'll show you that. It now said at November 2007. Remember, I wanted us to do up to 2007 from the requirement. Okay. It says 600 eligible employee had left the company. They now estimated that at that same time that 500, they estimated the number of employees leaving the year to 30th November 2008 to be 500 acts. So that means at the end of 2007, they estimated people that will leave, all right? So, and we're giving the fair value. So please be with me. I don't know whether I should also go and solve this, at least to demonstrate the impact of people that are leaving. Can I do that? I'm also watching the time because we also need to check ratio analysis. Okay, maybe I should do that for you. The solution is there actually, but so that I can explain people that are leaving. All right, so let me quickly go to the board. So you can see my screen. Let me look for the okay. I think I have the question here. All right. So okay. So let me demonstrate this so you can understand. I'll be willing to do that, even though I'm still watching the time. All right, so let me go to a new board. Wow, this is all the calculation we've been doing. I can see disposal, foreign currency. Wow. I really work. We almost covered the syllabus. So wow, this is interesting. It's very interesting. I'm happy. Okay. So we are still dealing with IFRS 2. Okay. So what's the name of this? I just wanted to demonstrate that to you. So please be with me. So we are still dealing with, I hope you can see my screen. Please, if you can't see, just come to the WhatsApp. I'm trying to check that. Okay. So what's the name? Debt. All right. So this is IFRS 2 because it's an option scheme. All right. So you will write all your whatever. This is an option scheme. So that means the grand fair value we use to measure the instrument. So you're going to use that. So you see all of that. So check your notes. Then you write your formula. All right. Should I write it? Okay. Liability equals to number of shares expected to vest multiplied by fair value, then multiplied by value ratio, right? Okay, so bet granted 200 share option to 100. Okay, so let's do the way we did it earlier. We say start, right? Then we say increase, then we say closing year 1, right? So if you don't want to write closing year 1, you can just say 30th November 2007, right? You can just quote the end of the accounting period. So please be with me here. Be with me here. This is the complication I said I will explain in the around number of shares expected to vest. So the examiner may not give you straightforward information to say 500 shares for 50 employees, you just multiply, right? But the moment you start saying people left, are leaving, then it's a bit of complication, but it's very simple. So just listen, right? So I am in year 1. Start of year 1, that's year 0, okay? So don't also forget, not all the time the examiner will give you information in year 0, okay? So what I've normally seen is closing year 1, year 2, year 3, or at the end of the year, okay? But in case you decide to do that, probably because of marking scheme, you may want to do this. So, and that year 0 is usually the beginning of the accounting period. So he said Beck granted 200 share option to each of the 10,000 employee on 1st December 2006. Okay, so I will come here. I will say how many shares did he grant? It says it granted 200 shares, right, to 10,000 employees. Okay, so I can say 200 shares, right? So it's giving it to 10,000 employees. Does that make sense to you? I will now ask these employees, I'm at the beginning of the accounting period, and we estimate how many people will leave. Does that make sense to you? How many people will leave to till the vesting date? So nothing has happened in the past. Okay, so I am at the beginning of the accounting period. So what I mean is, and this is 2-year contract, have you? So how many people will leave in year 1 and leave in year 2? The question will tell you. Let's find out. Now it said in paragraph 3. Or is it paragraph 3? No, paragraph 2. It said on 1st December 2006, Bet estimate that, can you see, on 1st December 2006, that's the beginning of the accounting period, Bet estimated that there will be 1,000 eligible employee living in each year up to the vesting dates. 1,000 eligible employee living in each year up to the vesting date. Can you see that? So, and it's an estimate, right? How many people will leave in year 1 and year 2? So it's saying 1,000 in each. So I will now come here. I will say minus 1,000 in year 1, then minus 1,000 in year 2. Sometimes you can just say 5,000 will leave up to the vesting date. So you just say 5,000, or 1,000 will leave up to the vesting date. Say 1,000. But you already said 1,000 in each. So if it is 3 years, that means 1,000 each. The 1,000 in three places. So because I'm teaching, right? So that's why I'm doing all of this. So if I'm doing this exam, I'll just net it off and move on, right? So that's what we have there. I'll now multiply by fair value. How much is the fair value? It says 10 naira. Okay. Then timing ratio 0/2. So even if you did not get that correctly, you still score 0. You still get 0. But you need to get it actually, because they will assign mark to that. Okay. So does that make sense to you? So at the beginning of the year, I will estimate how many people will leave. Does that make sense? Up to the vesting period. What happens at the closing year 1? So let's find out. What happens here? I will say my 200 shares. Okay, I'll now say multiply. Please be with me here. This is not arithmetic. This is accounting. Okay, if it is arithmetic, I would have I've said 10,000 minus 2,000. I mean, 10,000 minus 1,000 and 1,000, right? So that means I have 8,000 left. This is not mathematics. I'll bring all my 10,000 employee back. Okay, because what the standard says is at the end of each year, we have to remeasure the liability. I will now come with my 10,000 employees. Be with me here. So when I bring the 1,000 employee, remember, this is the end of the accounting period. I will now ask, how many people left in year 1? A lot of event has happened, because if you promise all your employee, work for me for the next 3 years or 2 years, I'll give you shares. It's all of them that will stay. Okay. So I will now ask that question. How many people left in year 1? The question will tell you. So that's why you need to navigate the question by the principle. So when I look at the question, what did he say? He said, remember we are at 30th November 2007. He said in the second paragraph, 30th November, line 2. 2007. It's line 2 in my own book here. I don't know where it is there, but check the second paragraph. It said, at 30th November 2007, 600 eligible employees had left the company. So this is actual now. So left the company, 600. Okay. Remember, there is still 1 year ahead. Abi, I will now estimate how many people will leave. Let me take that again. Once you can clear this in your head, you are fine. No, the next thing we need to now learn is performance condition. That will be all for IFRS 2. So let me take it again. At year 0, you estimate how many people will leave because nothing has happened in the past, right? That's the beginning of the accounting period. How many people will leave up to the vesting date? So that's why we have that 1,000, 1,000. So it's an estimate. But the moment I get to year 1, at the end of year 1, you know, I've spent 1 year already from the start of year 1, which is year 0. So I've spent 12 months. I'll now ask, how many people had left? That's actual. Here it says 600. I will now estimate again how many people will leave. The question will tell me. It says they estimate the number of employees leaving in the year to 30th November 2008 was 500 at 30th November 2007. So it says 500 will leave. Can you see that? So I'll bring the 500 there. Okay. I'll bring the 500 there. So it's actual and the estimates. Did you see that? So that's what you're doing. Now I will now multiply by 10 because it's an option. Okay. Then I will now say multiply by 1/2. Can you see? You know, in this question, it didn't ask me to do for year 2. Be with me here. Let me quickly explain that. If I now get to year 2, which is the end of the contract or the option scheme, okay, I will now ask how many people left in year 1 and how many people left in year 2. Does that make sense? How many people left in year 1 and how many people left in year 2? I will bring back that 10,000. I will not have, but in this question, it didn't give you that information because it didn't want me to calculate up to year 2. It just wanted me to do year 1. Okay, so let me take that again. At the beginning of the contract, if it gives you information about year 0, you will estimate how many people will leave. So when I get to closing year 1, I'll say how many people left in year 1 and how many people will leave in year 2. If I get to year 2, which is the end of the contract, I will now ask question, how many people left in year 1 and how many people left in year 2. If it is 3-year contract, be with me. If it is 3 years contract, I will say at the beginning, how many people will leave up to the vesting date, which is the 3 year. You can say 1,000 in each of the year. You can say 10,000 for the whole period. That's what you will use. When you get to year 1, closing year 1, you just say how many people left in that year 1, then how many people will leave up to the vesting period, which is year 2 and year 3. If I get to year 2, how many people left in year 1, left in year 2, and will leave in year 3? And if I get to year 3, it will be how many people left in year 1, left in year 2, left in year 3. That's it. That's it. So you can get that. Yeah, good. So I will check this. I'll say 10,000 minus 1 multiply 200 times 10 divided 2. Okay. So this is giving me 89. Is that 89 million? Okay. Okay. So this is what this is giving me. So I can post in my equity and my expense. Okay. So that's it. That's it. Any question for me? Any question for me? Any question for me? Any question? So that's it. That's what you're doing. Okay. That's what you're doing. So I hope you are good on that. You have the solution in your notes, but I just wanted to demonstrate leaving left in and all of that. Yeah, I hope you understand that. Okay. Okay. I think that is good. Thank you. So let me move away from here. So let me quickly explain the other aspects, and I think you should be able to take it up from there, right? Please confirm you can see my screen. Okay, great, thank you. So okay, so this is what I just did. So, if you notice here, I use 8,000. Yeah, I didn't incorporate. Okay, I've incorporated the 1,000, but I didn't show you the way I did. That's why I love to solve it myself. Okay, so you have 8K, but you know how we got the 8K, right? 1,000 here, 1,000 here too. And you know how we got the 8 9 here. 600 actual left. I think 500 estimates. Okay, so we're actually correct. Okay, so take note of that. So let me quickly explain performance conditions. Be with me here. This is the last thing you are learning. So what we have done is service condition. Work for me for the next 5 years. I'll give you shares. I'll give you option, blah, 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 all of that. Now, it's also possible that in addition to the service condition, an entity can give performance conditions. Okay, and performance conditions can be divided into two. You have market-based performance condition and non-market-based performance condition. So be with me. How will you know in a question that it is a market-based performance condition? The entity will make reference to its share price. What would they say? They will say, I will only give you these shares if the company attain a minimum level of share price or a minimum share price. For example, at the time of granting the option, right, the share price can be 2 naira. And they will say, if you work for the company for the next 5 years, which is service condition, or in addition to that, our share price must have risen to, let's say, 4 naira 50 kobo before we can, grant you the share option. That's the meaning of market condition or market-based performance condition. So that means the entity will always say, before you can be entitled to these shares, the company share price must have risen to a particular level. So how does it impact on the account? I'll explain that shortly, right? Or your calculation. I'll explain that shortly. What non-market based is not related to the share price. You can say our revenue should be certain amount, or we should have achieved certain percentage in the company's sales or in the company's revenue, or you can relate it to profit after tax. You can relate it to EPS, earnings per share. Okay. So once that performance condition is not related to share price, that means it is non-market based performance conditions. So let me take that again. So once you see a question, it is an IFRS 2 question, and the condition is not limited to the service condition. Service condition means work for me for so number of years, I will give you shares, right? Then performance condition is before I can give you, even though you are working for me, my share price must rise to a particular level. That is market-based performance condition. If it is no share price, we was talking about profit after tax, it talked about EPS, it talked about revenue, all right? That is non-market-based performance condition. Does that make sense to you? Okay, so how will it now impact on your calculation? According to IFRS 2, if it is a market-based performance condition, you will not consider it. What does that mean? Be with me here. This is the last thing you are learning. You will not consider it in your computation. It simply means that, for example, let's say the market price or the share price of the company was 2 naira at the time the share was being granted, and the company says the target is 5 naira before they can give you the share, right? But at the end of the day, the company eventually met maybe 3 naira 50 kobo or 4 naira. It will not impact on your calculation. So what that means is you will ignore that condition. Does that make sense? Ignore the condition once it is market-based condition. And what is the position of IFRS 2? IFRS 2 says that share price has already been incorporated when the fair value of that instrument was determined. You know, there's a fair value in that formula. Number of shares expected to vest multiplied by fair value multiplied by timing ratio. Okay, so the standard is saying ignore that condition. Whether it was met or not, it will not impact on your calculation. Does that make sense to you? That means the way we have been doing our calculation earlier, you do it that same way because the market-based performance condition, it is related to the share price. And because the share price had already been incorporated when determining the fair value of that instrument. So that's what IFRS 2 says. But the moment it is a non-market-based condition, be with me here, is relating it to EPS, is relating it to sales, or is relating it to profit target, okay, you have to consider it when you are doing your calculation. So that means they must meet that target before they will be entitled to those shares. If they did not meet it, that means they will forfeit it. That's the meaning. So for market-based condition, you ignore it, and that is strictly for the share price. But the moment is any of EPS, sales price, sales revenue, or profit target, you are going to consider it. So please take note of that. Oh, it's even here. I didn't know. Sorry. So that's the impact. So I've already explained it. So you know all these things are in my head actually. Okay, I didn't know it was there because this is actually the meaning. Yeah. So this is the impact. So that's the impact I've been trying to explain. So take note of that. So let's now look at the question. So if you look at this question, let me quickly show you. On 1st January 2021, 100 employees were given 50 share option each. So this is key, each. So that means we'll say 100 multiplied by 50, right? But it was given on 1st January 2021. So this is also very important, right? Then now says this reversed if the employee work with the entity up to this. So the moment you say if they work or if they stay with the entity, that's service condition. Okay, that's service condition. And the second one, share price on that date is more than 5 naira. So this is market-based performance condition. Did you see that? Will I consider it? The answer is no. The moment you see it, just ignore. You now said on 1st January, the fair value was not on 1 naira. So this is the fair value that you're going to use when you, that will be part of your formula, you know. And the share price on this date was 3 naira. Okay, that's December. The share price was 3 naira. Remember, the target was to be more than 5 naira. And it was considered that it was considered unlikely. Look at this. They are considering it that they're saying it's unlikely that they will meet that 5 naira by December 20x2. So whether they meet it or not is none of your business. Just ignore it. And why are you ignoring it? The share price is already incorporated when they are determining the fair value. So that says 10 employees left during the year and a further 10 are expected to leave. He wanted us to do it just for year one, all right? So that means when I look at my 100 employee, so at the end of year one, I will estimate how many people left. It says 10. Can you see? How many people left? It says 10. So I'll say 100 minus 10. Okay, 10 people left. I'm just trying to analyze that. We have the solution already. Then I will say how many people will leave. You say a further 10 are expected to leave in the following year. Can you see that? So that means I will have 80 left. So I'll now say 80 multiplied by 50 multiplied by this 1 naira fair value, then multiplied by timing ratio. The timing ratio should be 1/2 because this is 2-year contract. And that's the end of the question. So it's as simple as that. Is that what we did here? Yes. Can you see? So this is what we did here. So that's the 80 here, 80 people multiplied by 50 shares, multiplied by 1 naira 1/2. That's it. That's it. Okay, I even did opening here. Okay, so look at this. The contract is share option, hence grounded fair value will apply. Also, since it is a market-based condition, share option reverse if the share price more than 1 naira, the condition will be ignored because that's already been incorporated in the fair value of the instrument. Can you see that? So please take note of that. So let's now check. Let's check this question. And I think this should be the last question for IFRS 2. So let's see. It said on 1st January 20x4, an entity, Blueberry, granted share option to each of its 200 employees. So the moment you are seeing all this, underline immediately. Okay, subject to 3-year vesting period. So this is 3 years. So if I'm doing my timing ratio, it will be year one will be 1/3, 2/3, 3/3. If you're going to do for the entire year, provided, so this is a condition, that the volume of sales increase by a minimum of 5% per annum. So that means it's giving performance condition. That is more, it's not service. Service is work for me, right? And since it's talking about volume of sales, so that is performance condition. And I'm going to consider that when measuring my liability, because it is a non-market based performance condition. It said a maximum of 300 share option per employee vest dependent upon the following. So it said if the volume of sales increase by an average of between 5 and 10 per year, each eligible employee will receive 100 shares. Can you see? So that means when I'm doing whether year 1, year 2, year 3, I will check their performance. So if it is between 5% and 10%, can you see that? It is between 5% and 10%. That means I will use 100 shares. That's the meaning. So that means in this question, the question will be solving. The shares were constant. But so here, because the non-market based condition, the shares will not be constant. So it will be dependent on their performance. And it says if the volume of sales increase by an average of between 10% and 15%, can you see? They will receive 200 shares. So please take note of this. Okay, I'm not saying I can't testing this kind of question before. So, and I know you will do that in a very soon, actually. I'm not sure whether it's this time. So that's why I keep taking it every time. It now says if it's increased by an average of 15%, okay, they will take 300 share option. Can you see? So that means when I'm doing my computation, I'll check their performance. So based on their performance, anywhere it falls into, I will use the share, to do my computation. And outside the grant, the Blueberry estimated that the fair value of the option was 10. Okay, so that means in my favor, that's what I will use. It now said at each reporting date within the vesting period, the situation was as follows. Okay, so he has given us the information or the situation. So he gave us reporting date 3 years, employees leaving, further leavers, annual increase, expected sales average. So let me check. Okay, I think it says if the volume of sales increased by an average. Okay, so he wanted us to use average. So let's see. So that means we are using this. So we are going to use this average annual increase. It's different from expected. Okay, so and it's also different from annual increase. So we wanted us to use average. So this is their performance. Okay, so in year 1, that's 31st December. What's it called? 20x4. So their performance was 14%. Okay, and in 20x5, it was 16%. So that means I'll go and check where is 16%, 14% falling into. And of course, in 20x6, it was 16%. It says calculate the impact of the above share-based payment scheme on Blueberry financial statement. So what do we do here? You know what we do, Abby? So this is an option. We say liability equals the number of shares expected to vest multiplied by fair value multiplied by timing ratio. So the number of shares expected to vest will now be 200 employees. Can you remember? So we have 200 employees. Okay. So I will now check how many people will leave. So I am in year 1. How many people will leave? Employee leaving in the year. Can you see that? 8. I'll say 200 minus 8. Can you see that? Then further leavers. How many people left rather? How many people left? Because I'm in end of year 1. Okay. How many people left in year 1? It said employee leaving in the year. So that's 8. And further leavers expected prior to vesting period, it said is 18. So it will be 200 minus 8 minus 18. All right. Then, but the shares I will use here, is dependent on the performance. That's why they call it non-market-based performance condition. So they met 14% here. I'll now come back to the conditions. It says if they meet between 5% and 10%, they'll be entitled to 100. 14% is higher. Can you see that? So 14% actually falls here. It says 10% and 15%. So they'll be entitled to 200 share options. So I'll use 200. So I'll say 200 minus 8. You know, there are 200 employees. So 200 minus 8. 8 is the people that are left in year one, and 18 is people that will leave. So 200 minus 8 minus 18 multiplied by 200 shares. How did I get the 200 shares? It says they met 14%, and this is 10% and 15%. Okay, so they are entitled to 200 shares. I will now go to year two. The solution is there. I'm just explaining. I will go to year two. Year two is December 20x5. I will recall the entire 200 staff. I'll call it back. I will now ask, how many people left in year one? Remember, there were 8 that left in year one. And how many people left in year two? There were 6 that left in year two. So the 200 minus 8 minus 6. And how many people will leave? Can you see that? How many people will leave? There are 4. Okay. I will now check what shares are they entitled to. Here it says they need 16%. So I'll go to the condition. Where is 16% falling into? Can you see? 15% and above. Average of over 15%. Can you see that? Average of over 15%. So what shares are they entitled to? 300 shares. Can you see? You know, year one, we used 200 shares. But now we are using 300 shares. So I'll now use 300 shares to compute my year two. Then in year three, this is the end of the contract. Okay, this is the end of the contract. I'll now say how many. I'll record the entire 200. I'll now say how many people left in year one. It says 8. How many people left in year two? It says 6. And how many people left in year three? It says 2. That's why nothing is there. Even if the examiner has put a number there, you will not use it, except it's up to year 4. Okay, so you estimate for people that will leave in year 4. So left in year 1, left in year 2, left in year 3. Okay, I also check their performance. It was 16%. Of course, 16%, they were entitled to 300 shares. And that was the end of the question. That's the end of the question. So that's exactly what we did here. Can you see that? That's exactly what you did. So this is 200. How many people left in year 1, 8? How many people will leave? So because they met, I think 14%, was that 14%? Yes. So that's why they're entitled to 200 shares. I will recall the entire 200 staff. I will now check how many people left in year 1. It says it's 8. How many people left in year 2? It says it's 6. And how many people will leave in year 3? It says it's 4. And because they met 16%, they're entitled to 300 shares. And I will in the last year, I will say 200. I will record the 200 staff. How many people left in year 1, 8? How many people left in year 2? And how many people left in year 3? Okay. And they also meant 16%. That's why you have that 300. So then you perform every other arithmetic, and that is the end. So that's many of performance-based conditions. Okay. So you have this question to solve as well. I think the solution is there. So at your leisure, you can solve that. And don't forget, this is your key takeaway. Okay. IFRS only applies when an entity settles an amount payable by issuing its shares or share option or incurs liability for cash payment based on its share price. So obviously, if it is equity settled share-based payment, use the grant date fair value. And if it is cash settled share-based payment, use the current date fair value. Thank you so very much for listening. I wish I can do ratios, but time is gone, and I don't want to rush it. And then because of the technicality of IFRS 2, that's why I took it slowly so that you can understand. But don't worry, we'll take it up tomorrow by the grace of God. We're going to start with performance measurement. Let's see how far we can go. Then we check other aspects of the syllabus. So thank you so very much for staying tuned. I think I have a question. Please, I don't understand the market. God. Do you understand now? Please confirm. Market or no market? I did a lot of explanation in that regard. I said market is related to the share price. Okay, it's related to the share price. You mentioned it. I think I gave an example. And once the share price, just ignore. It won't affect your calculation. Non-market based is anything outside the share price. It can be EPS, it can be profits, it can be sales, like the question we just solved. Okay. So, and you are doing your calculation, you must consider it. And I think I've showed you that. Okay. Please, sir, why didn't I use annual increase in sales? They mentioned it. I think I know somebody will ask that question. So I deliberately went back to show you why you are using average. It was mentioned. Look at this. I even highlighted it. It says if volume of sales increase by an average, is there. So just pay attention to the question. Okay. It said average. Yeah, it's already mentioned it. So don't just go and use anyone you like. Okay. So use whatever he has told you. So it's giving you all those other information is it to convince or to confuse you? So always pay attention. Is that okay? All right. So I hope I've been able to deal with that. Okay. Any other question for me? So thank you for staying tuned. Thank you for your endurance. Thank you. Thank you. I wish I can solve all the question on the chat. In fact, I actually plan to do ratios, but at the same time, I don't want to rush this because it's not regular standard. Okay. So in your preparation, don't ignore the theoretical aspect. It's very important. Okay, maybe I will help you to prepare a note on conceptual framework, ISB conceptual framework. So don't forget that. Don't forget that it's 24. It's been a while you tested that, and I think I've taken you that. Don't forget IS 41 agriculture. It's also been a while. Okay, so either of IS 19 or FIS 2, you'll see one of them, obviously. And okay, so just have idea of almost everything, but these are my feelings actually. Probably I'll also prepare, I hope I have time, maybe by weekend, I'll also have to prepare some mini mock mock exams that you can use to mirror yourself, right? Whether you are really ready for this exam. So don't ignore theoretical aspects, and I can bet it with you. You see scenarios where the examiner has already computed those figures. You wanted you to check whether it is correct or not. So that's why good understanding of all of these standards will really help. Thank you so very much. I hope there is no more question. Okay, so we're going to see tomorrow by God's will. So we'll start off with performance measurement. So depending on how far we go, we can quickly check some other aspects of the syllabus, IS 3 and then IES 12, so to speak. All right. Have a great night's rest. I'll see you tomorrow by God's grace. Good night.